Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on tonight's program, I'm going to ask my expert guests on how they're going to play the Omicron variant to the coronavirus. This is spooked stock markets, particularly on Friday, a lot less today. But my question is this really going to be a buying opportunity because some stocks have been oversold? Today, it was expected the market would sell off big time, but it fell only 0.37%. But we still have to ask the question, is this possibly a sucker's rally? So to find out whether it is a sucker's rally or not, I'm going to be asking Julia Lee of Berman Invest, Jun Bei Liu of Tribeca Alpha Plus, then Ying Yi Ann Cheng of Coolabah Capital. We'll ask about what the bond market's thinking about and what's going to happen to interest rates. Then Paul Rickard, he'll give us his take on what's going on, plus whether Woodside is a buy or not. So let's kick off with Julia Lee of Berman Invest. So Julia, thanks for joining us.
Great to be here, Pete.
So let me get inside your head. The people watching this are not professional investors. You are. That's what you do every day of your life. When the Omicron problem bobbed up on Friday, what was your reaction? What were you thinking about how you would play after Friday? How are you going to play today? And then how did you play today?
Sure. I guess the unusual thing about Friday was it happened on a day where it was pretty quiet. So if we have a look at the US, we had the Thanksgiving holiday on Thursday, which meant the US stock markets were closed. And then on Friday, it's actually a half day over in the US. So a lot of people are on holidays over that Thursday, Friday, and then the weekend. So there wasn't a lot of volume. So part of it was panic selling that was happening in terms of the market. I think what we saw over the weekend was we saw two of South Africa's top doctors coming out to say that what they've seen so far is that there's been very mild symptoms with this new variant. So look, that's added a little bit more confidence to the market. Of course, it is very early stage, but for the time being, we haven't seen a huge spike in hospitalizations and deaths as yet. So we'll be keeping a close eye on that. So it does look like this new variant might be more transmissible, but hopefully would have lower symptoms. So that's what the market's banking on or hoping for, but we won't know for a few weeks yet. But in the meantime, we've seen a bit of a relief rally in terms of the futures market. We've seen the Nasdaq futures up by around about 1% and the S&P futures up by 0.8%. So it looks like we're going to see a bit of a bounce back in the US tonight.
Now, you've talked in the past about how you're happy to position yourself with reopening trade type stocks. What companies in particular excited you today?
Sure. I think when these bouts of volatility happen, it's important to take a bit more of a longer time frame and ask yourself, what's the world going to be looking like in 3 to 6 months' time rather than 2 to 3 weeks' time? So I guess that's the question for investors at the moment in terms of positioning. Even before the new variant, we'd already seen cases starting to rise in Europe. So what the market's doing at the moment is really holding off on pricing in more interest rate hikes sooner. So what the market's pricing in at the moment is that those interest rate hikes will happen later in time. So that's been good news actually for some of the growth related stocks. We know the tech stocks, when interest rates are rising, we usually see tech shares falling, but we've seen the opposite today. And the tech sector has been doing quite well in terms of the market. I've topped up on a bit of Qantas today at $5.75. It ended the day, I think, at about $5.90. So $4.90, so $4.75. So
it worried me that I'd written a story about Qantas being $5, and I thought, did I get it wrong?
Yes. It's been pretty volatile. But look, people are still traveling over to the UK. So look, we'll see what happens in terms of travel. But travel has been hit very hard over the last 2 days. And today was a pretty amazing day to watch. I mean, at one stage, I think Flight Centre was down 11%. And, by the end of the session, it had less than half those losses. So we certainly saw some buying coming in during the session. So it'll be interesting to see what happens tomorrow. And of course, in the weeks ahead. But I think the bigger question for investors to ask themselves at this point in time is, well, what's going to be happening in the next 3 to 6 months? Are we still going to be worried about this variant? So look, whenever something happens in terms of the market or in terms of the stock, I like to ask myself, is this a once-off or is this something that's going to stick around for a while? So look, the next few weeks, things should become clearer. But for the time being, on what we know at the moment, my view is that in 6 months' time, we're still going to be looking at reopening. And look, the fact is we're in a very different situation to where we were in February 2020, where we're much better at dealing with the virus, whether it's through treating the virus, through vaccinations, social distancing, masks, and in the worst case scenario, in terms of lockdowns as well. So look, I think that we'll get quicker and quicker at dealing with these virus variants.
Okay. What's your view on commodities? I know you've been really supportive of New Farm, if I got that right. And we have been asked questions about Incitec Pivot. What's your view on that company?
Sure. So some of the stocks I've been topping up on today include Incitec Pivot. Really, the agricultural cycle's doing really well. And, you know, we haven't seen much in terms of drought or bushfires, although we're seeing a lot of rain at the moment, which actually bodes well for crop yields. So things are still looking good for Incitec Pivot. It's also coming up to a dividend payment on the 1st of December for anyone who's looking for a dividend, and franking credits as well. So look, I think the agricultural stocks are still in an upcycle here. The other stock that I've been topping up on today is Aristocrat Leisure. I initially got out of this when it looked like they wouldn't be successful in Playtech because there was another bidder for Playtech, but that bidder bowed out of the game last week, and for me that was a signal to buy. And really, that Playtech acquisition is all about online betting as well as online gaming, and gives Aristocrat Leisure a jump up in terms of the US market. And I think one of the things that Aristocrat Leisure does really well is it's got the content, it's got the games. So to have this online platform where it can put its games, I think makes a lot of sense. So Aristocrat Leisure is another one that I've been topping up on.
Well, I know you're always a bit of a gambler, Julia. What about Crown? I always remember Rene Rivkin, clearly a long time ago, said to me, when it comes to a bid, often the first and second aren't the last two. There's often more bids. What do you think's going on with Crown? Do you think we'll see another bid?
Yeah, I mean, I like my numbers. I wouldn't call that gambling. I like my horses as well, but I don't gamble on them. I do buy horses for my husband who likes his race horses. But I guess looking at Crown, usually the general rule of thumb with takeovers is buy on the first bid. But look, we've seen this company already trying to make a bid for Crown with another party. They've come back on their own this time. So just watching this space very carefully. But it looks like, you know, Crown seems to be out of the danger zone, and it looks like it's been let off pretty lightly in terms of its licenses. And of course, its properties are valuable as well. So looking at both Crown as well as Star, and I think, you know, this is part of the reopening trade that they should do well over the next 12 to 18 months, as long as their licenses are intact and they don't have too many onerous provisions in terms of that licensing.
Julia, thanks for joining us. Talk to you next week.
Thanks, Pete.
Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. And Jun Bei, love to know what you're thinking about this new curveball of the Omicron variant of the coronavirus.
Look, my thinking is, yes, it does provide a little bit more uncertainty given the countries are very quick to shut down borders, affecting a little bit of international travel. But so far, the borders are really just shut to the countries where we don't have that much traveler anyway. So the financial impact is really small. Now, the financial markets, global share market sort of fell a lot late last week, and not so much today in our share market. It's partly because, you know, the variant, we do have vaccines available for other variant, and to come up with a the alteration or a new vaccination, it will be say maximum 3 months. So it's nothing like what we saw maybe a year and a half ago before we had vaccination. So so on that path, we kind of think that it is a scare, it is uncertainty, but it's nothing like what we experienced in the last 18 months. So, and the market has proven to be very resilient. We have traded through all these other variants, Delta and so many other ones. So all in all, we think yes, market was a little bit toppy, it sold off a little bit, but it does provide pretty good opportunity to have a look at some of those reopening trade again, because they've been sold off so much here and internationally.
Yeah, because on Friday, corporate travel, for example, was clobbered, and Qantas and Boeing over in America, and everyone went off to buy Zoom again. It kind of like we over-calculated the necessity for lockdowns, wasn't it? That seemed like the Friday reaction.
That's right. You're absolutely right. And if anything, currently we're looking at what the US market might do today, tomorrow. It's actually pointing pretty positive. So if anything, I think we'll recover some of the losses we experienced from last week.
Yeah. Okay. Now, I read with great interest that you were one of the great predictors at the Hearts and Minds conference last year, tipping Treasury Wine Estates. So we're going to look to you to give us some. And I'm sure you actually told us Treasury Wine Estates already on this program, but what are you seeing as the buying opportunities for the year ahead?
Look, we see plenty of them, and especially when market becomes volatile like this, it gets really excited and we just go, okay, what do we buy today? So, there's a couple ones come to mind. First of all was a Zero we talked to before. It's got sold off more recently. Result was pretty good, but just a little bit behind expectations, but very backward looking, forward looking, things are good. Things like that we like. We saw recently, Domino got sold off, quite a bit because of missing the expectation a little bit, but of course today's went up a little bit. Share market is very unpredictable on this basis, but certainly it's still quite well down from its highs, and it provides good growth opportunity. Other businesses we saw that has been sold off. Seek is another one. Seek actually is one that we think will do incredibly well in the next 12 to 18 months, because not only is a structural growth story, it is a business that's very leveraged to the improving economy and the jobs. If you look at the job index, it's going through the roof. And if anything, people actually haven't started even churning the jobs yet. So there's so much demand for new people, but people haven't even yet to start moving. So in that kind of environment, we see this business very well positioned, and it's not as expensive as what it used to be. And it's it's just a business that will deliver good growth on the 5-year view.
Okay, well, let's talk about Seek for the moment. One of the underlying challenges for the economy are supply chain problems. Now, one of the supply problems is the lack of workers in this country. Something like 350,000 foreign workers left during the coronavirus, and there's a high expectation that a lot of workers will come back. So, in a sense, Seek would probably find it harder to make money when there are less workers around, but the more workers that show up, that's actually going to be a good thing for a business that matches businesses that want workers and with workers who want jobs.
In a way, yes, that's right. Because as more people come back, more people will move, and then there will be more vacancy. Then it hence lead to more job ads. So we're looking at pretty good job ads boom for the next 12 to 18 months. Yeah.
Okay. So let's move on that. Earlier tonight, I was talking to Paul Rickard on the program, and Paul has always been a little bit hesitant on Woodside after the BHP move, but he now is becoming more supportive of what might happen to Woodside. Do you have a view on the oil price, the global recovery, and whether Woodside is a buy at these levels or not?
let's say the oil outlook. Yeah. So in terms of oil prices, I think it has become quite volatile because of, obviously new variant. People become risk off, be scared of what the outlook may build. But let's not forget, there's demand improving. Eventually, the international travel will resume, and the supply is still being disrupted. And then we've got all these, the energy shortages around the world because of the winter and all of that. So these are things to stay, which means it bodes pretty well for the energy market, energy prices. We did see, it was down over the weekend, double digit, but it recovered 5% already today. So, oil is actually in a pretty sweet spot for the next 12 months. So it's a good sector to have some exposure to. But do be mindful, these are the assets that over the long term, investor base will continue to shrink because it's fossil fuel, it's bad for the environment. The investor base will continue to shrink. So that means eventually the terminal value, the asset value in many years' time will be almost zero. So taking that into account, still you can make good money in the oil in the next 12 months, and when things are still going well, and we think oil is a good place to be. Now, Woodside, we do have a clear preference for the likes of Oil Search or Santos. Just simpler story, more scalable business rather than the Woodside. Woodside a little bit more complex. They are buying a high quality asset from BHP, but the problem is when BHP early next year, when BHP do split out its oil asset to its shareholder, structurally a lot of BHP shareholders don't want to, or they can't hold Woodside shares, so they'll be forced to sell this, say, early to mid next year, and that's a lot of shares to be sold. So just on that basis, there seems to be a little bit of structural pressure just on that, on the Woodside. Just a harder story to like, really.
Yeah. Okay. Now, one area I'd like you to pass your view on, and that is the payments sector. Ever since Afterpay was taken over by Square, payments companies seem to be under pressure. We've seen Zip, its share price has fallen, Tyro's share price has fallen. Why is there a set against payments company? Is it because they're sort of linked to tech? When they seem to fall at the same time as tech, and tech tends to fall when interest rates are on the rise. What's your take on what's happening in the payments sector?
Actually, you're absolutely right. Ever since Afterpay got bid for, it seems like a dud. The share price has been falling ever since. The key changes since when the Afterpay was bid until now is that the outlook for interest rate is looking a little bit higher. So we're looking at interest rate going potentially higher around the world, probably late next year, next calendar year. Now, in this environment, for companies that doesn't make free cash flow, so company doesn't make free cash flow. Most of those payments company don't make free cash flow because they got to keep spending to grow the borrowers, right? So grow, borrow, and keep spending. So none of them are really cash flow profitable. So for that sort of business, its valuation is very much underpinned by, what the interest rate expectation is, because, you use your traditional valuation method like discounted cash flow, and you get to your today's value. So all of them have fallen in value purely because that, the macro environment of what's changed. The company hasn't changed. It's really just the valuation has, they were expensive. Now they just fallen a little bit just to be in line more with where everything else is trading on now.
Yeah, but as Warren Buffett said, when everyone is fearful, it's time to be greedy. So for the long-term investor, are these payments companies looking like good value, or do you think their prices are going to be terminally low forever?
Like some fund manager might tell you, like the trend followers, they may tell you it's time to sell. No, it's not. So actually, it's absolutely time to be looking at companies when no one likes them, right? And to reassess whether anything's really changed, but nothing's really changed. My view is that for especially buy now, pay later, most of those companies won't be listed anymore in the next 12 months because they're so strategic for these large fintech, and they will get taken out. So none of them will be in existence. So I still see a lot of value in this space.
Okay. So if you were going to go in that space, what companies would you go after?
Yeah, so at this point, I do think Tyro makes a lot of sense, simply because it's so cheap now, and it is one of those reopening trades where they release the weekly data. It's now now up significantly from what it was last year, because it's exposure to the cafes and restaurants, and then also travel in further down the track. Essentially, its volume just track those businesses coming online. It got sold off recently on really, we had a bit of Delta, we had a bit of, now that we have this new variant, so they got sold off because of, people a little bit worried about the lockdown and things. But I think that's overblown, and it is very, very cheap relative to all the other fintech at this point.
Okay, right, yeah. Well, Jun Bei Liu, great to see you, and we'll see you in a couple of weeks' time.
See you soon. Thank you.
Well, to get a bond market take on how they're interpreting the potential threat of Omicron, I've got Ying Yi Ann Cheng from Coolabah Capital. Thanks for coming on, Ying Yi.
Thanks, Peter.
All right, now, of course, none of us really know what the potential threat is of Omicron, but we do know it's a threat. Stock markets have reacted. And also, I think in the US on Friday, bond yields went down. That's another reaction. As professional players of the money market, what are you guys saying today?
Yeah, look, I mean, obviously, we're yet to sort of find out more details from the health authorities with regard to, I suppose, the seriousness of this particular variant. Thus far, the anecdotal sort of reports via the media have said that essentially, while this is more, I suppose, it transmits much more easily than the Delta variant. What we have heard from the South African scientists who did sort of discover this particular variant, she has been sort of saying that the symptoms are milder. So we're yet to see the full sort of implications. I think the reports thus far in Australia have been that the two new sort of cases have been asymptomatic, and those two young people have also been vaccinated as well, which I suppose sort of helps. I think the broader concern that really stoked markets last Friday was essentially when we were found out about the variant. We knew that there were, quite a lot of mutations, about 32. Obviously, that's been counted now. And then at the same time, there was a rumor that it would be vaccine resistant as well. So, given the seriousness of the vaccination rollout program and, given that's been the primary sort of defense barrier in terms of trying to get to herd immunity, that definitely has been a cause for concern. But obviously today, things are sort of easing up a little bit, but we're yet to sort of find out. We're still very early stages as well.
Yeah. All investments in either the equity markets or the bond market is always about risk management. And clearly, Coolabah have been, so involved in risk management that even when the coronavirus came, you got all your smart people, probably including you, to actually try and work out when we would see a vaccine turn out, when we'd start getting on top of the spread and all those sorts of things. Ultimately, my feeling is that we're more prepared for this than we were with Delta. And so in a sense, the economic response is probably going to be a little bit less dramatic, a little less sensational. Is that your reading of what we're seeing so far?
Yeah, I can't disagree with what you've said, Peter. And by all means, I think the fact that we've had such a successful rollout of the vaccine here and definitely makes governments much more sort of confident with respect to dealing with this, and they have sort of emphasised this. So it depends on the efficacy of the vaccine against this particular variant. I guess we're yet to sort of find out. But at the same time, in terms of like how we, I suppose, approach this, and it definitely is a key risk to markets. But I would say that right now in our portfolios, we are primarily focused on super safe government bonds, particularly those issued by the state governments. And if anything, I think we've sort of been through this cycle where we were in lockdown and there were concerns that the states would have to issue a lot more debt. We've come out of that whereby the states, basically New South Wales and Victoria in particular, have come out of lockdown much sooner than the market expected, which means that the cost to the actual states themselves is going to be a lot less. So that is a key sort of a positive that we've had. And then obviously all the other states have managed this quite well. So the risk for us is obviously, looking ahead and saying, okay, could this put the whole of, New South Wales and Victoria into lockdown again? And I think, judging by the government sort of slant, whether it's from the federal government and even, I suppose the government of New South Wales, Victoria, and even to a certain extent WA now these days, they're moving much more towards the vaccination target as to the guide as to whether we shut or lock down particular economies. And I think, as you say, that makes economies much more resilient in dealing with this new variant than we were originally with Delta.
Okay, so is it fair then to say this, that if it proves what you said earlier, that while this may well be faster to infect people effectively, but less impactful when it does, that the interpretation will be, okay, this is just another phase of learning how to live with this virus, but it's not going to lead to economic restrictions, significant ones, and therefore it might slow down the recovery, but it will not stop the recovery. Is this a fair argument to?
I think that's fair.
At this point in time.
I think that's fair. I mean, obviously we are sort of getting into winter in the Northern Hemisphere, so there's, heightened concern there. And, across the European countries, there's still, massive sort of variations in how well vaccinated they are, right? As you know, in Germany, in Ireland, in Austria, and even the Netherlands, they're going into lockdown. So, but, their vaccination rates are around 60 to 70%. So they're by no means like to the same extent as vaccinated as our population is. And so, to put on that sort of extra defense barrier, that's why they're going into lockdown. Whereas for us, it's a bit different.
Yeah. Okay. Yeah. Apart from the fact that, we love hanging out with you, Ying Yi Ann Cheng, for no good reason, or just hanging out with you is great fun. One thing we do love to find out is what you guys are thinking about interest rates right now.
Yeah.
So when is your expectation that the Fed might raise interest rates, and when is your expectation that Australia will see higher interest rates?
Yeah, the indication for the Fed will likely be mid next year. And that's definitely been the indication. And I think the reappointment of Powell by Joe Biden suggests that the government is obviously happy with how the central bank is managing things. Obviously, this new Omicron variant could be a particular sort of a risk, but, thus now don't really sort of see that being as an impediment to them, removing quantitative easing, tapering back, and then ultimately raising rates as well. And I suppose the pause or the lag between the two, between tapering and then also hiking, is unlikely to be very long either as well. So probably mid next year, that is priced in, and obviously that's what's gone markets quite sort of a bit concerned, in addition to the inflation print, right? With respect to the situation in Australia, look, the RBA is very resistant to raising rates anytime soon, and that includes next year. So it's unlikely that they want to raise rates until 2024, which was their original argument, right? When they had yield curve control, they said rates would be fixed at 0.1% until 2024. We think that is still the case for them, but at the end of the day, they have flagged that they are data dependent, and that, if we get consistent core inflation prints within that 2 to 3% band and we get higher wage inflation, then that might move the dial. But wages will be key in Australia. And ultimately, as we've sort of spoken about on previous sort of catch-ups that we've had, it really comes down to the fact that our borders have been closed. They still are technically closed to non-resident workers, skilled migrants as well, and also, international students. So once things do sort of normalise, that should take the pressure off wage inflation and, if anything, have almost a deflationary effect.
All right. So I want you to be sensational, and I know you won't be, but still I'm going to try and make you be sensational. The CVA economics team thinks that the economy will be strong enough by November that the Reserve Bank might have to raise cash rates. Do you guys totally disagree, or do you agree if the economy looks very strong second half 2022?
Yeah, I mean, I can't entirely disagree with what they have to say, but again, I'm not sure whether they have taken into account these borders reopening and wage inflation. So, let's see how that pans out, and whether, firstly, inflation is truly transitory, and then secondly, how the wage inflation numbers sort of pan out.
So the important point you've made then is, if we get a lot of foreign workers coming back and foreign students over the course of 2022, that then reduces wages pressure and takes away the inflationary pressure, which will be the prime driver of the central bank moving. And that's going to be a really important thing to watch.
That's right. That's right.
Okay, great stuff. Ying Yi, thanks for joining us.
Thank you so much, Peter.
Well, we've talked to fund managers and we've talked to a representative of the bond market. And now I want to go catch up with Paul Rickard to see how he's going to play the Omicron challenge to the markets. Paul, good to see you.
Yeah, thanks, Peter.
So how are you going to play this new curveball for the stock market?
Well, I think I'm with you, Peter. I think it is a buying opportunity, probably just a little bit of patience required. I'm not surprised that the market basically went up from the opening day. I thought that was always going to be the case. We sold off a lot on Friday ahead of it. And of course, the news over the weekend perhaps wasn't as scary as people expected. So when I read the futures were down 104 points this morning, I thought it was a buy at the opening. It's really the way it's finished. It's sort of gone up steadily all day. But that said, I think there's, as we've seen before, Peter, these things aren't over in a day or a couple of days. And we've seen, previous drops around 5 to 6%. So we sort of had, I guess, at our worst about 3.5%. I'm not sure it's all over, Peter. So I think that there's going to be buying to come.
Yeah. It seems to me, Paul, that if the view is that this could get worse, well, then the market will react. But if the view is that the world can handle this new curveball of the virus, well, then there'll be a sort of gradual buying up of those stocks that may well have been instantly hit for a 6.
Yeah, I mean, I think the sort of situation in Europe is potentially still more worrying than Omicron. Mainly because, we could see a much bigger impact on global growth if Europe goes into lockdown. And so that's really which I think started the slide last week, and we've just sort of seen that it play out with the announcement out of South Africa. So I think a little bit of patience is required. There are some good opportunities. I think the oil price has been really interesting. I think the way it fell in New York, or at least Chicago, I guess, on Friday, and bounced back so much in Asia, it's presented some great opportunities in some of the oil companies if you're prepared to take a bit more of a view that's longer term. Growth is strong, and OPEC or OPEC Plus have shown a remarkable ability to be incredibly disciplined.
Yeah, behave as one, if you like.
Yeah, very much so.
All right, so you've actually looked at Woodside, and it's been a company that you've had question marks over for the Scarborough project, CEO problems, now the BHP selling of its oil assets to Woodside. All of these have been interesting curveballs / challenges for the company. What's your latest take on Woodside, Paul?
Well, I describe Woodside, Peter, as a gunner company. It was always gonna do great things, but it's never quite got there. You know what I mean? And because we've got to remember with Woodside, it was the takeover that former treasurer Peter Costello famously knocked back in 2001. That was a takeover offered by Shell, who were going to pay over $40 for the company. And he knocked it back on national interest grounds. Well, 20 years later, Woodside shares are trading at $21. And, Shell got out. They were lucky they got out. But if you've been a long-term Woodside shareholder, you've seen an enormous amount of, destruction in shareholder value. Notwithstanding that, you'll hand some of the projects in the Northwest Shelf and others, are fantastic projects, but it really hasn't done a lot for shareholders. And I think, the current project, Scarborough, is a bit like that, an alleged 13.5% internal rate of return. That's pretty optimistic given that 6 years it won't be ready. The first production won't be to 2026. It's a $12 billion project. You've got all sorts of issues around, environmental issues, ESG concerns, let alone all the actual development and construction work. And then is there going to really be a strong market for the gas? So Woodside itself has spent over 3 years just trying to make the final decision. So it doesn't inspire a lot of confidence. That's probably the way the analysts are reading it. What they do like, Peter, is the merger with the BHP oil interests, which has now also got the green light, and that's due to take. Shareholders will get to vote on that in sometime in the second calendar quarter of next year, and be implemented by the 1st of July. And if you're a BHP shareholder, you got to get some Woodside shares. It'll be treated as a fully franked dividend, an in specie fully franked dividend. So that's going to make it pretty attractive as well, particularly for low rate taxpayers. So some interesting things to cap in there with Woodside shares. I guess, I think there's value there around $20. You're just going to have to be a bit patient, I think.
So if you're holding Woodside at this point of time and you're in the money, you might have bought in $17, $18 around when the crash was on, would you remain a holder, or would you take the profit and run?
No, look, I'd probably hang on. I mean, I thought today, at the first up this morning, they were down almost 5%, off their Friday close. I thought they looked great value. So I think it's a good hold long term, and it's a good buying around about $20 for those that can be patient. But you're going to need to be patient. And one of the things, we're going to have to play out is when something like 950 million new Woodside shares are going to be issued, Peter, when they get when each BHP shareholder gets some Woodside shares. So that's a lot of new shares hitting the marketplace. And there'll be a bit of an overhang for a period of time. So I think you've got sort of, good long-term prospects, some great assets. The merger with BHP oil and gas looks on paper to be pretty attractive, better diversity of assets, better geographies, synergy costs, all sorts of things, or synergy benefits, I should say. But you have this overhang of scrip in the marketplace, and it may just take a long time to clear. So I think there's some good buying, but I think time's on your side with Woodside.
Yeah, it sounds as though it's the stock for a very patient investor, not the younger, let's get in there, slam bam, thank you, ma'am type investor.
Well, yeah, I mean, that said, Peter, good dividend yield, over 6%. It's not a big multiples. I mean, on current forecasts, the market has it trading on a multiple of about 11.5 times this year's earnings and only 8.5 times next year's earnings. So you've got to say there's a lot of value there in terms of the current price. It probably should be a lot higher, like a lot of the oil companies, but it hasn't. It's been an underperformer the last 24 months or so, or post-COVID, it's been an underperformer. And at least we've now got the uncertainties out of the way. We've got a CEO, we've had a decision on Scarborough, and we know what's happening with the BHP merger. So the three major things that were sort of overhanging the share price have gone. The trouble is, this is a long project, and there will be a temporary surplus of stock, I think, in the market for a while. So,
okay, one important question then is to finish up. Given what you said about OPEC, and they seem to be good at controlling supply, that even their reaction to Joe Biden releasing emergency reserves, they talked about cutting back their supply if he wanted to do that. If we end up with a strong economic growth year 2022, do you think that's going to be good for both the oil price and the Woodside share price? If it's a strong economic growth year, we get over the Omicron challenges, and it's a strong year, that should be good for Woodside and oil prices?
I think so, Peter. I mean, it's one of the things, in fact, if any of the movements I looked on Friday, the fall of the oil price I thought was the most amazing, not because it fell, but it was by 13%. And that was just, a few days after the Americans had abandoned sort of releasing reserves, had seen no impact on the price. So it looked like a total overreaction to me. I'm just linking you two things. If Omicron sort of, plays out, I said at the beginning, perhaps you don't buy straight away. It could be a company like Woodside that gets sold down in something like this because people do fear a global slowdown. That might be the sort of stock to go for if in a good dip, because they'll probably go pretty hard down. So that means that when we get through it, it'll bounce back up quickly as well.
Okay, Paul, thanks for joining us.
Thanks, Peter.
That's Paul Rickard from the switzerreport.com.au. And before I go, let me remind you, tomorrow is the Switzer Income Conference 2021. It's free, so all you have to do is register in the link in the description below. Love to see you there. It's all about looking at the kinds of investments that you might be interested in if you want to try and get some good income in 2022. Hope I see you there.